Welcome back to the Gold and Alternative Investment Show. My name is Kerry Stevenson. I am a serial entrepreneur. I'm a real estate entrepreneur. You all know me very well as a gold nerd, and I'm passionate about getting you guys educated, waking you up to what's going on in this crazy time that we're all living in. And I'm really excited today that my good friend Brent Johnson, who is the CEO of Santiago Capital, based in San Francisco, is joining us today. Now, Brent's had over 20 years experience in the financial markets. He's really well versed to talk to us, not just about the big picture, the macroeconomic picture, but also we're going to delve a little bit deeper into what's happening in Australia. I think he's kind of bearish on Australia. We're going to talk about gold mines. We're going to talk about gold. We're going to talk about where we're going at the moment and all this money printing that's going on. Brent Johnson, welcome to the program. Thank you so much for your time.
Absolutely. I'm happy to be here. It's great to see you again. And, I think we're going to have some fun.
Excellent. Well, let's start off with, and some people who are watching this will know, you're very well known for your dollar milkshake theory. So can you just give our listeners an overview of the dollar milkshake theory?
Sure. And I'll say to start that, this is a thesis that has developed over several years. It started back in 2007 when I kind of had this fortuitous meeting, and you and I may have even talked about this when I was in Australia and saw you, was that I had this meeting with some clients who really kind of challenged my perceptions of things. And I went to my superiors, for lack of a better word, at Credit Suisse and asked them these questions, and they couldn't answer them. And I thought it was funny that they couldn't answer these relatively simple questions. And so it made me start digging in. And that's when I really started digging into the monetary system itself. A lot of the questions that were raised in this meeting came to be in 2008 and 2009. These people that I had met did very well through 2008, 2009, because they were prepared for it. And they helped me prepared for it. But Wall Street in general was not prepared for it. And that kind of prepared for me to understand that just because the so-called experts say something is true doesn't necessarily make it so. And so as I really dug into the monetary system and how it's designed and how money flows and how money gets created and how it gets into existence, that really pushed me to become more serious about gold and silver, and hence my belief that everybody should own gold and silver. Everybody, regardless of where you're at, the correct allocation to your portfolio of gold is not zero. Now, I don't know if it's 2% or 20%. I don't know what's appropriate for everybody. It's kind of a individual thing, but I know it's not zero. And I think it really also, the next function then becomes in what currency are you denominated? The same answer for somebody in South Africa might not be the same answer for somebody in Brazil or Russia or the United States or vice versa. And as we've kind of moved forward from the great financial crisis into what I think is going to be a currency crisis, and as I continued to dig into this, I realized that while, understanding that there's a basic understanding, if you print currency, the more you print of something, the more supply you give, that's going to push the price of it down, right? And it's not incorrect to think that. And I did a lot of work on the U.S. monetary system, and I came to the conclusion, early or late in the 2000s, that the dollar was going to lose significant value. And it did initially after 2008. They did QE, the dollar fell. But shortly after that, around 2011, it kind of, in 2012, it stopped falling and it actually started rising. And I think when I saw you in 2014, it was at the fall of, it was actually kind of right when I was down there was when the dollar started to make its move higher.
Yeah.
And I don't know if you remember this, but I think the month before I got down there, gold had a big pullback.
That's right.
And it was because the dollar was getting stronger. And I remember thinking, well, this is just temporary, right? But it wasn't temporary. And because going back to that meeting in 2006 or 7, when I realized the experts weren't always right, I said, well, what if I'm not right on the dollar, right? And so I kind of went back and challenged all my preconceived notions of what would happen with the dollar. And I realized that I had done really good work on the dollar. I was really proud of myself. But I also realized that I left out one of the most important factors, and that was that fiat currencies trade relative to each other. So I had done fantastic, if I do say so myself, research on the US dollar, but I hadn't done it on the yen. I hadn't done it on the euro.
Yeah,
I hadn't done it on the yuan.
you had just literally looked at the US
Yeah,
dollar and its
right.
comparison. You weren't looking at it as a
That's right.
currency
That's
basket.
right. That's right. That's right. And I got to tell you, it's such a simple thing, but it hit me like a ton of bricks
Yeah.
when I kind of realized that. And so I really started looking at other countries around the world, the problems that they were in, the challenges that they faced, and I came to the conclusion, much to my chagrin, I didn't actually and part of the reason I became so convinced that I was right is I didn't like the answer. You know,
Okay.
I didn't like the answer. I didn't like, because I was somebody who thought that, well, I still think, and I thought that precious metals is a very important part of someone's portfolio. And I think typically if you go to a gold conference, or if you're a gold investor, or if you talk to people in the precious metals world, fiat currency losing its value is one of the fundamental reasons for owning gold and silver. And so if I came to the conclusion that the dollar, which is my fiat currency, it's different for you and it's different for a Brazilian and a different for someone from Switzerland or whatever, but my fiat currency might actually rise in value. It didn't kill the opportunity for gold, but it provided a headwind to gold. It took away one of the tailwinds for gold. And the more I looked into it, the more I came to the conclusion that we would get into this surging dollar. Now that brings me to the dollar milkshake theory. So I sorry for that big long setup, but I think it's important to kind of understand where it comes from.
Yeah, and I do think it's important because what you're talking about is, and it's interesting that you talk about all the different currencies, because back in 2011, when the US dollar gold price was, I think, about $1,900, the Australian dollar was at parity to the US dollar.
Yeah.
So at that time, the Australian dollar gold price was 1,900.
Yeah.
Flick through to 2020, and the Australian dollar gold price is the highest it's ever been. It's
highest
now
it's ever been.
2,700. Right. So that
right.
actually puts forth your thesis, which is you've got to look at different currencies.
And yeah, and I think that is one of the most important. It's hard to, in today's global age. I mean, you're in Australia, I'm in San Francisco. We could very easily have somebody from London on the call with us, right? And so, in this day of globalization, and the fact, well, we're not flying anymore, but we can communicate pretty easily. You can kind of have these conversations, and you have to remember that it might not apply to you if you're in a different country in a different currency. And I really do think that's key to understand. And so, anyway, as I did more research on the dollar and the monetary system, I came to the conclusion that for a number of reasons, the dollar was going to go through, for lack of a better word, a short squeeze. There's not enough of it around for the demand that is put on it. And while the Fed...
Sorry to interrupt you, Brent. Is that because many countries, obviously the US dollar is the reserve currency, and there's many countries around the world that want US dollars. So there's a demand for USD outside of the US.
That's absolutely right. And it's gotten to the point where the demand and the supply and the need for dollars outside the United States, there's a number of different ways to measure it. But you can argue pretty successfully that the market outside the United States is just as big, and perhaps in some cases bigger than inside the United States. Now, the reason that becomes important, which many of people who are in the gold world will understand and are a gold investor, is, we got into these periods of booms and the busts, right? The central bankers print currency, we get the big boom, it gets too big, and then we have a crash. Well, when that happens, then the central bankers have to come back in and provide currency to recollateralize the system. That's just the way the system is designed. It's like a margin account. It sounds silly, but the global monetary system is very similar to a brokerage account with margin on it. When asset prices fall a certain level, if you bought those assets on margin, you have to put new collateral into the account. It's the same thing with the global economy. People borrow money, they go and invest it, but when the asset prices fall, you have to put new collateral into the account, into the system. The only person or the only institution that can put dollar collateral into the system is the US Fed. The ECB doesn't have the authority to print dollars. The Reserve Bank of Australia can't print dollars. The Bank of Japan can't print dollars, but yet their local corporations need dollars for either funding purposes, trading purposes, debt purposes, for what, multiple reasons that dollars are used. And I think many people will agree that the rest of the world is frustrated with the dollar. Maybe they don't like the dollar. Maybe they would like to leave the dollar. But the fact is there's no other global system, right?
Yes.
Now, I think the biggest competitor to the dollar is gold. But just because it's the biggest competitor doesn't mean that the world is going to embrace it and the governments of the world are going to go back to a gold standard tomorrow. The gold price could go up, but that doesn't mean that, the whole world's going to get redenominated into gold. And so that's when I came to the conclusion, well, wow, the gold can continue to go up, but because everybody needs dollars and because there's going to be this short squeeze on the dollar, there's just not enough of them around for the demand that's put on them, then the dollar can go through a short squeeze as well. And when that happens, that could be a headwind to gold or maybe not. But versus other fiat currencies, the dollar is going to go a lot higher because, there's not a lot of demand for Australian dollars outside of Australia, right? There's not a huge demand for yen outside of Japan. There's not a huge demand for euros outside of Europe. There's some, but not like the US dollar. And so, again, because of all the debt that's in the world, and the debt is the primary driver for dollar demand. And I have a lot of people that will then say, well, what if they just default on the dollar? They'll just default on the dollar, and now they'll trade, Australia and China will trade in Australian dollars or yuan or whatever it is. Well, and they say, and that when you default on the loan, the demand is gone. That is true. But the problem is when money is loaned into existence, if you default on a loan, you actually you're pulling that collateral out of the system, and it creates it destroys other money that was loaned into existence, because one man's loan is another man's collateral. One man's loan is another man's asset. So when loans default, it actually destroys money, and it destroys more supply than just that loan. That's why when you get into credit contractions, it's so contagious. One house loan going bad makes the house next door go bad. Pretty soon the neighborhood's in trouble, then the city's in trouble. It kind of catches like wildfire. It's the same thing in currency markets. And so, the fact that if the world just decided if everybody at the same time decided to default on their dollars and go to a new system, it would work.
Yeah.
But when you do it a little bit at a time, piece by piece, and one little player does it, it creates a chain reaction of a crisis. And I think that's what we're on the verge of. I think what we saw in March, I'm going to steal a line from Churchill. It was, and people keep asking me, is this almost over? And I keep telling them, this isn't the beginning of the end. It might be the end of the beginning. That might have been the opening battle, but this is now going to play out over the next couple of years. And I think it's going to, unfortunately, it's going to bring pain to a lot of people who are not prepared for it.
Do you think that this would have come about regardless of the coronavirus and the I guess with everybody across the world in lockdown, there's no velocity of money.
Yeah.
Do you think that we'd still be in this position without
I do. I think we would still be in the position, although I think this has exacerbated it and perhaps accelerated it. Although here's an interesting part about it is, when we had this big, if you think about it, we were in March, that was just a pure liquidation panic. Asset price, there was no decision making on whether this was a good price to sell at. The decision was sell, I just need dollars. It was that was a global margin call on the dollar. Everybody needed dollars. And the central banks had to act very quickly, and in large size in order to stop that margin call. As part of that, government policies also came out and said, what, we're going to, people who don't have to pay their mortgage this month, we're going to defer it a month, or we're going to defer it 6 months, or renters have 3 months before they have to start paying again. Or, if you have an outstanding invoice from this supplier, they're going to let you, you can pay it in 90 days. You don't have to pay it tomorrow. Everybody kind of, got sent home. Everybody kind of pushed pause. And so therefore, everything just kind of stopped. And when the velocity of money stops, that actually creates a huge problem. But the interesting thing is that because they also delayed payment, those bills aren't defaulting, right? Yes. Because the people who are owed the money have just said, it's okay, pay me in a couple months. But when the economy opens back up after COVID passes, whether it's, next week or next month or 6 months from now, whenever whenever global trade starts to happen again, and those invoices do need to be paid, and they can't be paid, then
then we
that's, that,
it's like
then we're going to see the fireworks, so to speak. So so I would say that the COVID has exacerbated the problem. It at the same time brought it forward, but it also pushed pause for a little bit. So I think we would have hit it anyway, but now I think with this COVID, it makes it even bigger. Because
and Brent, I was going to say that to you. Do you think that, you know, with this pause, I guess it's almost like a build-up of the water in the dam, and when the floodgates open, it's almost a bigger issue and a bigger crisis than it could have been.
It is. The analogy I like to use, and I use it, and I use this especially when talking to people in the gold world, because they always get it very quickly. So we always use, as one of the arguments for gold going higher, is that the amount of trades that take place on the COMEX are like 200 times the level of the actual physical gold that's backing all these trades. And if people who trade futures would just stand for delivery, you know, the COMEX would never be able to deliver it all, and the price of gold would go through the roof, right?
Yeah.
Well, the interesting thing is the exact same thing exists with dollars. It exists with Canadian dollars, it exists with Australian dollars, it exists with euros. It's just the way the system is. There's only a small amount of base money, and the rest of the money is loaned into existence.
Yeah.
But when those loans start getting called in and everybody goes for the base money, the actual cash, the actual money that actually exists, there's just not enough to go around. And so that pushes the price higher, right? So the analogy I use is that same thing that exists in gold, with there's, you know, 200 times the number of contracts versus the physical gold. People will use the musical chairs analogy. As long as the music's going around, it's no problem. But when the music stops and people go and grab the chairs, there's just not enough chairs. Well, the same thing exists in the currency world. And what COVID has done is, you know, there's basically $6 trillion that's the US monetary base. But there's a number of different monetary aggregates that you can use to say, these are the claims on those 6 trillion. So I think global dollar debt is around 70 or 80 trillion, just as a rough estimate.
Yeah.
It's actually, I think, higher than that, but let's just use that number as an example. That means there's 80 people walking around 6 chairs, right? Well, and initially it was four chairs, but in the last 2 months, the Fed's come in and bought so much stuff, they added 2 chairs to the system. So now people are still walking around, and what the music is still playing, but the referees came out and said, okay, everybody just stop. We're pausing for a couple minutes. We're going to take a rest. The music is still playing. You don't have to go for a chair yet. You can't move. You just paused. And so everybody's kind of standing there looking at those chairs, right?
Yep.
And they know the music is still playing, but they also know the music's going to stop at some point. And when they unpause the game, and people actually have to start paying those bills again, and they have to start making claims on that on those chairs, it'll be interesting to see what happens with the value of those chairs. I think the value of the chairs is going to go up, and that's the price of the dollar.
Do you really think the music is going to stop, or do you think that they've got a way of bringing in some more musical chairs, or just getting going for a bit longer? Because as you and I know, this is a system that's been going on for a very long time. Why is it going to stop now?
Well, it's a very good question, and I may be wrong on this. The interesting thing is, when I saw you 6 years ago, I said I thought we were close to the end. Well, you know what? They did a very good job of spinning the plates. They're still spinning. Yeah. And I always say, as much as I don't really like the central bankers, I give them credit, because from their perspective, and if you subscribe to their point of view, they've done a fantastic job of keeping it going. Right now, I don't like what they do. I'm not a fan of theirs, but I recognize that they have done a good job, if you look at it from their point of view, of keeping it going. I think what is different this time is the fact that now, you know, when we had the Asian currency crisis in the late 90s, it was an Asian crisis that could be solved by the Asian central banks and the Asian, economies. When we had, the global financial crisis, it was actually located in the United States. It was the real estate. You know, the real estate of the United States kind of caused the global crisis, and the Fed could fix that. The problem now is that it's a US dollar crisis, but it's located outside the United States. Well, it's located inside the United States too, but it's a dollar crisis outside the United States.
It's a global dollar crisis.
It's a global dollar crisis, but the Fed only has jurisdiction over the United States.
Yeah.
And so I am of the opinion that the Fed cannot bail out Brazil, that they can't bail out Australia, that they can't bail out Indonesia, that they can't bail out Hong Kong. Now
they don't want to bail out.
Well, that's the other part of it too, right? So you've hit on a very important topic. Is the swap lines. So okay,
now,
so the swap.
Brent, can you explain? Because I did a really bad job the other day, because there are, I believe, 15 countries in this. But can you explain it a bit more? Because I did a really bad job the other night trying to explain it.
Okay, so think of a swap. The swap lines were set up in 2008, basically for this exact reason that we've been talking about now. When there was dollar funding needs outside the United States in 2008, the Fed set up these things where they would give dollars to the European Central Bank, and the European Central Bank would give euros to the U.S. So it's a swap. But I think it's important to remember, these are not gifts. These are swaps. And there is a maturity date at which these need to be returned. Now, they can be rolled, just like a loan can be rolled, and the Fed can extend it. But what happens is we give dollars to the European Central Bank. The European Central Bank then goes to their constituent country central banks, so the Italian Central Bank, the French Central Bank, the Bank of England, and they'll say, how many do you...
No, Bank of England's no longer in it.
Oh, that's right. Sorry, no, that's right. Or the Bundesbank, and they'll say, how many dollars do you need? You can bid on these. They're loans. We will loan these out to you. So then the country central banks come in and get from the European Central Bank. And then those country central banks go to their corporations and say, how much do you need? How much do you need? How much do you need? And so then they're basically giving loans out to the corporations who are already in so much dollar debt that they couldn't even fund themselves. So again, they're just making the problem bigger. It's still a loan. It still needs to be repaid. We didn't just give these dollars to the rest of the world. And I guess my point is can they extend it a couple times? Yes, but I don't think that none of this is going to, unless we get growth in the world economy, none of this is going to get fixed. And the debts are now so big, there is not enough growth to outgrow the debt. So the problem is just going to continue to get bigger and bigger and bigger and bigger.
But back to your point before, Brent, why doesn't everybody just default and say, look, the loan is just too big? It's like, I've got a mortgage, I've lost my job, I can't pay the bank back, so I walk away, I go bankrupt. I just go, oh, well, I can't do it anymore. And why did they then set up their own local currency?
Well, if they do, here's the problem with doing that. If you do that, there's two choices. You can default, but then nobody is going to want to, like Argentina is a good example. Yeah. Argentina is bankrupt again, right? The biggest loan in IMF history 2 years ago, and it's already bankrupt. So now let's say they default on it. The debt is wiped out. So now Australia wants to buy, copper or nickel from Australia, right? Or Argentina wants to buy from Australia. Do you want to, are you going to sell that in Argentinian pesos? Are you going to accept Argentinian pesos? No. You're going to want Australian dollars, or you're going to want some other collateral, right? But you're certainly not going to do it in Argentinian pesos. But they don't have Australian dollars. So they've got to print Argentinian pesos and then go buy the Australian dollars. Well, what happens when they start printing a currency that nobody else wants? Then their currency hyperinflates. That's how you get hyperinflation. You get hyperinflation when you have to print a bunch of a currency that nobody else wants. And that's why I keep saying that the US dollar is not going to hyperinflate until everybody else hyperinflates, or until there's a new system that everybody else goes to. If everybody else goes to a new system and they don't want our dollars anymore, and then we have to print our dollars to get a piece of their new system, then we would have hyperinflation. But right now, there is so much demand for the US dollar, like it or not, that it's not going to hyperinflate. But as these other countries either default on their debt and then need to print their own currency to get other currency, those are the countries, those smaller countries are going to go through hyperinflation before the US dollar.
Well,
And it creates a vicious cycle.
yeah,
It feeds on itself.
yeah.
Yeah.
And speaking of feeding on itself, I mean, recently we've had some, and especially here in Australia, there are some challenges between Australia and China. Where do
Yes.
you see China sitting within this whole messy
Yeah.
global
Well,
currency US dollar debt?
yeah. Okay. So I think China is in very big trouble. I think that they are going to eventually have to depeg their currency from the US dollar. I think when they do that, it won't be because the yuan gets stronger. I think it will be because it gets weaker. I think they were on the right track of, setting up their own bridge and road, Belt and Road initiative, and they were trying to, set up, a system where they would, fund these in yuan. But I think the crisis happened too soon. I think they did too little, too late.
Yeah.
Had it waited another 5 or 6 years, maybe they would have had a chance. But I think this happened too soon. Here's where it really gets interesting. These swap lines that I was talking about, I don't think the Fed can bail out the whole world, but we can bail out a few of our friends. So what I mean by that is the dollar will be used as a weapon. Okay, Brazil, you need dollars? We'll give you dollars through a swap line, but now you need to support our foreign policy versus this country, or you need to support you need to sell certain amount of your goods to us at a predetermined price. I mean, look who's in charge of the US right now, right? Donald Trump. You think that if he has this as a negotiating tool, he's not going to use it? Of course he's going to use it. I've used this example, but I think it's a good one, and I think it's one that everybody will understand, is that, right now in the United States, Boeing is having a lot of trouble. So Boeing is our national aircraft. They make airplanes. The biggest competitor for Boeing is Airbus, made in France. So as we try to get Boeing out of debt, because Trump has already said he doesn't want Boeing to go bankrupt, they're going to have to figure out a bailout for Boeing. Well,
and that's in the billions of dollars, correct?
Billions of dollars, that's right. And so to bail out, but part of bailing out Boeing would be, well, how can we get them more customers? How can we get them to sell more planes? Well, the way you get them to sell more planes is that to compete better against their competitor. Well, who's their biggest competitor? It's Airbus in France. Well, what is Airbus in good shape? No, they're getting bailed out. Well, who are they getting bailed out? They're getting bailed out by the Bank of France. Well, who's the Bank of France getting bailed out? By the ECB. Well, who's the ECB getting bailed out by? The US Fed. When Trump says, wait a minute, you're telling me that we are bailing out Airbus at the same time that I'm trying to bail out Boeing, Trump's going to say, you're crazy.
Yeah.
And now Trump does not control the Fed. The Fed is supposedly independent. But at the end of the day, the Congress oversees the Fed. And this idea that central banks are always independent and never do what the leader of the country says, I think is, a little silly. And even if technically they are independent, all Trump has to do is go on the news every day for 10 days in a row and say, your central bank is bailing out Airbus while people in Seattle are unemployed. How do you like that?
Yeah.
Just, he can do a lot. He can put a lot of political pressure on the Fed. The point is everybody thinks the Fed is politically immune, but they are not. I think that they are not. So this is why I say the Fed cannot bail out the rest of the world. They can bail out a few people or a few countries here and there, but the idea that they're just going to flood the world with dollars via swap lines with no strings attached, I think is wrong. I think there will be many strings attached. So let's use Australia as
just going back to what you said before. So the swap lines were actually started in 2009.
I think 2008, 2009. I don't remember the exact date,
but the global financial crisis. So they said, we need to create a bit of a system here. It really hasn't come to the forefront very much at all up until this time of coronavirus.
Sure, right.
And is that because it's a political tool?
I think it's a little bit of both, right? China is not going to get a swap line. There's no way that we are going to politically bail out China via swap lines.
Right.
And we may even start withholding swap lines from countries that are doing business with China that maybe we don't want them doing business with China. Australia might be a good example. I mean, it's one of your biggest customers, right?
Yeah.
and we may decide that, we don't want, we don't want Australia exporting a certain metal to China because they use it in submarines or whatever I don't know. I'm just making it up. But my point is that this is going to be negotiation, guerrilla style. it's going to be down to brass tacks. And I think we've kind of, whatever you think about Trump, I think one thing that you have to agree that he's done is he has raised the level of interest or the issue between China and the United States, that maybe they're not our greatest friend in the world. Maybe we let them get away with more than we should have let them get away with. And even if Trump loses this next election, I think he's raised the issue enough that the next president can't come in and go soft on China. Even in the Democratic national debates, you would see a number of Democrats were talking very hard on China. So I think whoever does become president, whether it's Trump or somebody else, is going to have to maintain a hard line on China. And as a result, and especially with this COVID, this has exposed our dependence on China for certain industries, right?
Yeah, and it's exactly the same down here, Brent.
That's not going to be allowed. And so we're going to go back to, rather than having one global supply chain, we're going to go to two supply chains. And I think lines are going to have to be drawn. And I don't like it. I was a fan of, I liked it when everybody kind of got along and everybody was our friend, and, there was no wars and there was no conflicts. But, I'll bring up this line by George Bush, which I hated the line when he said it, when he said, you're either with us or against us. Right. Yeah. And I hate that, but that's kind of geopolitics. And I think we're kind of headed back towards that. I think that we're going to say to other countries, we'll give you help, but you're either with us or against us. And it's going to be on our terms. And now some people will back up and they'll say, screw it, I don't want to deal with the United States anymore. And maybe some of them will be able to stand up to the U.S. and maybe some of them won't. But, I think it's going to be an ugly time.
Yeah. And
I hate saying this. This is not what I want to happen. This is what I think is going to happen.
Well, it's the reality of it at the moment, isn't it? Because we are very much in what I would call a geopolitical war. I mean, China is flexing its muscle. Russia is also doing somewhat the same. And there are going to be lines drawn as to, okay, whose side are you on? Who do you want to play with?
Right.
But I'd like to, if it's all right with you, we've kind of looked at the big picture, but given that a lot of my viewers are down here in Australia, you're fairly bearish on Australia in the short term, but long term, you think we're going to be okay. And right now, as I'm talking to you, we have some challenges with our supply chain to China. And there's a lot of rhetoric being thrown around, and who knows where it's going to land. But what are your views when you focus and take a look at Australia?
Yeah, I mean, essentially, this is not a new story. You've heard this before. I mean, the twin real estate bubbles in Melbourne and Sydney, right? Some of the highest priced real estate in the world. I think that Australia, I'm not going to get this exactly right, but I think Australians, their household debt to income is close to 200% or something like that.
I think it's about a 170, yep.
Okay, so maybe 170. Anything in that neighborhood's pretty high, right?
Yeah.
You haven't had a recession in 30 years.
Pretty close.
You've dodged many bullets along the way, and now we've got a situation where I think the debts around the world they're just too big. So central banks are going to do everything they can to hold rates low. Yeah. But they can't. I don't think that they can force people to borrow. So the velocity of money, I think, is going to stay low. So even though they may lower interest rates or keep interest rates low so somebody can go out and take another loan and buy that house, I don't know if people are going to continue to buy at the same rate that they were. You probably know better than I do. What are the new, what do you call when you do the auctions for the houses? There's the what?
An auction.
Yeah, the auction rate, exactly. The auction rates. I don't know.
The auction clearance rates?
The auction clearance rates. Now, I know last year they took they initially started to go down and then they picked back up, like in the fall, right? But now with COVID, I haven't seen them in the last couple of months, but.
It went down for Sydney and Melbourne a few weeks ago. It was down to about 30%, but that was just literally because of lockdown. People couldn't get out to see houses. You're not going to buy a house you can't see, et cetera, et cetera.
Right.
they've completely turned around now because you can go and see houses now. And
Yeah.
I think the last weekend it was back up to around the 70% mark, which is high.
Yeah. So I think that will come down. And part of the reason I think that will come down is I think that your biggest customer is going to get into trouble. And when China gets in trouble, that will, that will have an impact on Australia.
Well, right now, Brent, in fact, that was a bit of the headline that the Chinese are still coming to Australia to buy property because it's seen as a safe haven.
Sure. But what happens when the Australians or when the Chinese can no longer get their money out, or because they go into a recession and their money starts to disappear? I think when China's money disappears and they can no longer come to Australia, that's going to be a hard time on Australia. And not just the money coming in to buy real estate, but the goods that you ship to the commodities that you ship to Australia. If you've looked at some of the manufacturing numbers coming out of China, I mean, they've just fallen off a cliff, right? And so their demand for raw material to manufacture, I think, is going to remain low.
But do you think that those are true numbers, or do you think that because there's kind of two arguments to this? It's the number that some people see, but the true number is China has 1.3 billion people, and they still need to grow. They are still growing at about 6%.
Yeah, they are, but I just don't trust anything coming out of China, to be honest. And I think this again, and I'm not picking on China here. The U.S. numbers don't look great either. The Canadian numbers don't look great either. The European numbers don't look great either. My point is that we were already at a point where I thought everybody was in trouble, and then Corona's just taken it down. I think the PMIs have gone from over 50 to the 30s or something in some cases, and so you've got these huge just cliffs. You look at all these different economic charts, and it's like waterfalls on all of them, right?
So why is the U.S. stock market going up? Why is the Australian stock market still strong?
Well, I think it's largely a belief that the central bankers will be able to keep the plate spinning.
Right.
And so, I mean, they have done a lot in just 2 months, right? Again, they came out with fire hoses and turned them on, but I think we've got fire hoses trying to turn back avalanches, and I just don't think it's enough. I think this debt that's in the world is just going to overwhelm the central banks. And specifically, again, because much of the world needs dollars, and because I don't believe the U.S. is going to bail out the rest of the world, I think we get to that I don't know if it happens next week or in the next 2 years, but I don't think we have 5 years left before this happens.
And in terms of Australia, where you're fairly bearish, what's your view? And you talked about China and our reliance to a certain extent on China. Do you think, putting it back into the sort of the gold space, do you think our gold miners will be in a good position going forward? I mean, other commodities may not be so much so, but
yeah. So I would say in Australian dollar terms, the Australian miners should do very well. I don't know, and they may do even well in U.S. dollar terms. I would say that they would do better in Australian dollar terms than U.S. dollar terms, especially if they're paying their expenses in Australian dollar, but selling their product in U.S. dollars, right? That could be actually very good for Australian dollars or Australian gold miners. So if I was an Australian dollar investor, I would own gold. I mean, I own gold in U.S. dollars, but I'm just saying if I was an Australian dollar, I would buy even more, and I would buy miners. One thing I would say with miners, one thing that the Australian miners have going for them is that Australia does have a swap line. So to the extent that, they need dollar funding, perhaps the Reserve Bank can provide that to them. If you're buying miners that are not located in a swap country, or who has projects that are located in a country that doesn't have a swap line, I would be a little bit more careful there, because I think those countries are going to need dollars, and the first place they'll look for it is, industries that sell their product in dollars, or how do they tax the industries more. So I would be a little bit more careful there. But with regard to Australian gold miners, that might be one of the bright spots, I think, in the economy.
Okay, so we're running out of time here. I'd love talking
already.
I could go on for forever. I just, what are you doing right
Yeah.
now
Yeah.
to, I guess, protect yourself and your family in this
Yeah.
unprecedented and unusual time?
Well, so, again, I should tell you, I no longer run my gold fund. I
Yes, I did
still,
know that.
we still own gold for clients. We own it through different vehicles. But I set up a fund about a year ago, where we are literally, we're shorting much of the rest of the world. And we're long US dollar assets and short the rest of the world, essentially. So we're short the Australian dollar, we're short the Brazilian real, we're short the euro, we're short the yen, we're short a number of emerging market currencies. We're short a number of commodities. Essentially, we think we're going to have another wave of deflation before the inflation picks up.
It's exactly what I've been saying.
Yeah,
Yeah, we're going to have
yeah,
deflation and then the
yeah.
inflation.
And it's the deflation which creates the storm of inflation, right? But I think but the debts are just too big. We're going to have another downturn, and we think the idea is that if we're right, because we think the dollar is going to get a lot stronger. And because when I say this, if you've ever seen a short squeeze, just do this. Go, if anybody's listening and you're not familiar with a short squeeze, go to Google, type in short squeeze and type in images, and you'll get all these charts that just show just the line going straight up. Because whenever something goes through a short squeeze, the price of it always goes higher than anybody thinks possible. A couple of years ago, Volkswagen went through an incredible short squeeze. There was a time back, I think, in the early '80s, where silver went through a short squeeze. A couple months ago, Tesla went through a short squeeze and went from like $400 to $1,000 in a couple days or a couple weeks. And so these curves, these exponential curves that come as a result of a short squeeze, always go higher than you think it's going to. And I think that's what's going to happen with the dollar. And when that happens with the dollar, that means other currencies are just getting crushed.
Yeah.
And so that's why, if the Australian dollar goes down a lot, or the Brazilian real goes down a lot, or the euro goes down a lot, gold in those terms should do very well, right? So what we're trying to do is we're trying to be long US dollar and US assets, because we think on a relative basis they will do better than the rest of the world. And we're short a number of emerging and what's that? Yeah, and everything else, right? And the idea, though, is that in a couple of years, when the dollar is very strong and the emerging markets and international markets are very weak, that we sell the dollars, we sell our dollar exposure, and then we go buy, maybe we'll buy that nice house on the beach in Sydney, and then as those assets reflate, because that's what'll happen. After that happens, then the dollar will go down, and the international assets will go up, international currencies will go up. And if you can go in and buy those and just let them reflate as the central banks either, pump the markets back up or whatever it is, you can just kind of ride that wave back up. But you got to have some profits to put to work at the bottom. That's the key.
So right now, get into US dollars, get into gold, silver.
So, okay. Yes, I do think that in the short term, gold is a little frothy. I think it'll probably pull back. But if I was in Australia, yes, gold, silver. If I was in Australia, I would own gold and silver and a bunch of US dollars.
Good to know.
Just sit there and wait, and you can buy back, sell your house, sit in dollars, and buy your house back at half off in 2 years.
Next question I've got for you is the age-old thing at the moment is people talking about the cryptocurrencies. And I know it's not something that you specialize in, but given that it is a part of the economic talk at the moment, what's your view on crypto?
So I think crypto is one of these assets that you just kind of have to own some. And, it's because the asymmetry of it is so high that if it works, there's just not that much of it, right? And there's the opportunity that, listen, Bitcoin could go to $0 or $1 million, and I don't know which one it is. I think it'll probably be somewhere in between, but I don't think it's going to zero. I don't think digital currencies are going away. I think they're too powerful. The genie's kind of out of the bottle. Yeah. Now, I do think that they are more susceptible to government control or government regulation, however you want to describe it, then a lot of people think, the government can't control it. I would beg to differ on that a little bit, right? But the asymmetry is still there. And they can control gold too, right? They can make gold illegal, but it's the asymmetry is such that you still own it just in case. So it's a similar kind of a thing.
And speaking of that, do you think that that would ever happen? That, you know, because it did happen in the past. You know, history can
Yeah.
repeat. Do you think
I don't think that they will confiscate gold. And the reason I don't think they will is that it would legitimize the asset that they've been trying to push under the rug for 50 years. I think that, you know, they may try to persuade people not to use it, and they may make it harder to use it. And they may, you know, outlaw its use, but I do not think that they will confiscate it. I could be wrong. Have a good hiding place.
Saying my internet is unstable. Maybe the government heard us talking. Brent
Exactly.
Johnson, it's been a delight chatting to you today. So, ladies and gentlemen, there you have it. I'm always telling it to you. If people want to get in touch with you, Brent, if they're keen on learning a little more about what you're doing, I can hold you.
Yeah, so I'm always willing to talk to people. I do get busy, and sometimes it takes me a while to respond. But you can send me an email, just brent@santiagocapital.com. I'm pretty active on Twitter. It's just Santiago AU Fund. I have a webpage with my it's just santiagocapital.com. You can go there, and it has my email and my phone number. I
know how busy you are. So guys, my people out there, please don't, you know, infiltrate his inbox.
It's all right. It's okay.
Check out santiagocapital.com. He's very prolific on Twitter. He puts his views out on Twitter a lot. So the Twitter handle again, Brent, was?
Santiago AU Fund.
Santiago AU Fund. So AU for Aussie. Anyway.
Yeah, there you go.
We hope to see you when we can all travel again. I hope to get you back down to our next gold conference, whenever that might be.
Would love to.
That'd be today.
That'd be fantastic.
For those of you out there, what I always say to you, and it's pretty much what Brent's saying: hedge and diversify. Hedge and diversify. Don't leave all your eggs in one basket. And right now, he's very strong on the US dollar. You know, maybe don't have too much debt. We live in interesting times. Who knows where it's going to take you? But as I say, be resourceful, get educated, and stop watching Netflix. Thanks, Brent.
Absolutely. Thanks for having me.